Hi, I'm James Robinson, and this is my stock pick of the week. This is the final section of my series on Electronic Arts, symbol EA. Today we're going to talk about the company's wealth creation, which is really the ability of the company to generate wealth for shareholders. As always, if you want to see real-time information on when I buy and sell stocks, you should follow me on Twitter. My Twitter handle is @RobinsonStocks. I don't always get around to making videos the second I buy a stock, nor do I make a video telling you when I sell a stock. But if you follow me on Twitter, you'll know what I'm doing in real time. You'll also find articles there that I post about our companies, or about the market in general, or other things that I find interesting. So again, please follow me on @RobinsonStocks. And as always, if you like the video, please go ahead and subscribe or hit the like button. One of the first things that a management can do to reward our shareholders and to return money to the shareholders and create wealth for the shareholders is to buy back shares. One of the benefits of buying back shares is that it is a tax-free way of creating wealth for the shareholders. The way it works is a company buys back, let's say, 10% of its stock. That means that the shareholders that are left own 10% more of the company, even though they didn't invest any money. In theory, they should get 10% more of the future profits, or they'll get the benefit of the stock price going up disproportionately because they own a larger part of the company. And because that money is paid out to other shareholders and not to the people who continue to own stock, it's a tax-free situation. So we always look at what a company does in terms of buying back shares as part of our analysis of wealth creation. Unfortunately, when you look at EA Sports, this company has done a relatively poor job of buying back shares. Since in the last 10 years, they bought back about 6% of the shares. Oftentimes, they're selling as many shares as they buy back. Generally speaking, companies in this situation, especially in the computer and high-tech industries, those shares are going to employees as stock options. But wherever they're going, when you sell shares, they dilute the owners. When you buy shares, it enriches the owners. EA Sports has really done a pretty poor job in this category. I certainly wouldn't give it anything higher than a 2, maybe even a 1 in this category. Looked at another way, if you'd owned 10% of EA Sports at the end of 2009, you would have bought about 32 million shares. Through stock sales, through stock repurchases, your 32 million shares of the company mean your ownership in the company's gone from about 10% to about 10.7%, which means you've had just under a 7% increase in the amount of shares in the percentage of the company that you own since you bought it. Not a big deal for 10 years, but that's not all there is to the story. The company 10 years ago had earnings of negative $67 million and earnings this year of $108 million over those 10 years. So you've done really, really well in terms of your profits per share. It's hard to believe you would have bought shares 10 years ago with the company losing $70 million. But if you'd done it, you'd have done great. Your earnings would have gone from negative $2.10 a share to positive $3.36 a share. And I think that's one of the reasons this company hasn't bought back a lot of stock is they saw what happened in the last recession and they're trying to build up a war chest. And I don't have a problem with it to a point, and that point is about now. I think this company's built a big enough war chest that they should be returning money to us, the shareholders. And my belief is that the company will either do that voluntarily or will be pressured to do it by activist investors, guys like Carl Icahn, etc. So another thing that we look at is stockholders' equity. And stockholders' equity is pretty simple. It's the total assets the company has minus the company's total debts. You can see that since 2014, stockholders' equity has gone up pretty dramatically. That's really gone up as a result of the company hoarding cash as a result of the company earning profits year after year after year and not paying dividends and not buying back shares. But the good news is the stockholders' equity tends to be a precursor for increased stock price, right? As the company gets more and more equity, theoretically, sooner or later, that'll show up in the value of the stock. So when I see stockholder equity going up year after year after year, that to me is a good sign that in the future, the value of the company is going to go up and the stock price is going to rise. There's an old adage that it takes money to make money, and that's true. What I'm looking for as an investor is I'm looking for companies that do a great job of making lots of money by using a little bit of money. So the goal is it should take a little bit of money to make a lot of money, not it should take money to make money. And so when you look at this stock, what we're looking at is return on assets. And we're looking at return on assets relative to other companies that I've analyzed. And you can see this company's in the top 10% in terms of return on assets of all the companies that I've looked at, which is 928 companies. And it's been in the top 10% of companies since 2015. And so what that's telling you is this company is very, very efficient. They're not requiring a lot of capital relative to the amount of money that they're producing. I love that. That's the kind of thing that makes a stock an almost instant buy for me. If the company has that and very little debt, I'm willing to overlook an awful lot because that means the company's a very efficient producer of profits. And very efficient producers of profits sooner or later create lots of wealth for shareholders, in my opinion. The next thing that we look at is return on shareholders' equity. Return on shareholders' equity is different than return on assets because assets is the total amount of assets, total amount of wealth that the company has is stored and is using to create money. Shareholders' equity is the exact same number minus the total amount of debt. So companies will be able to lever their returns as a result of debt. Now, our company doesn't have much debt, and so there are lots of companies that will do a lot better in terms of return on shareholders' equity because there's hardly any equity left after all the debt. Our company only has $1 billion worth of debt, so it has tremendous amount of shareholders' equity, which tends to reduce its profits relative to those companies, which return on shareholder equity relative to those companies that have a lot of debt. So we're still in the top 25%. Even though we have very little debt, lots and lots of equity, we're still doing a great job of getting a return on equity. So I look at that as a good thing because the way that you get super fantastic returns on shareholder equity is to load up on debt. But when you load up on debt, you also load up on risk. And I'm willing to forego some of that return on equity in exchange for the ability to sleep at night and the ability to survive pandemics and other things that happen. So I look at this issue, but it's not as important to me as return on assets. The next thing that I look at is retained earnings. So a company has a number of things it can do with its profits. It can use that money to buy back shares. It can use that money to pay dividends. It can use the money to pay down debt. Or it can reinvest the money back in the business, hopefully creating additional wealth from the shareholders because they can efficiently use the capital. So the first thing that I look at is how much money is this company retaining? Some companies retain a tremendous amount of money, which doesn't leave the company any money left to give back to the shareholders. Other companies retain hardly any money because they're giving so much money back to the shareholders. So the first thing I like to look at is how much is the company retaining. And this company is retaining actually a pretty significant amount of money. Frankly, it's retaining 100% of its wealth. It's not paying dividends or shareholders, not doing any things that it might be doing. So they're retaining all of that wealth. So the next thing that I have to look at then is what are they doing as a result of that? How efficiently is the money they're retaining being used? So we'll talk about that in the next slide. So this slide is very, very interesting. This slide is return on retained earnings. Now, this is an oversimplification. I'm just trying to get a gauge for roughly how well a job a company is doing in terms of creating wealth, creating profits from the money that they're retaining year after year after year. So this is a very simple equation. I know it's an oversimplification, but it just gives me a sense. And all I do is I look at the total amount of money that was retained over the last 10 years. And I look at the total amount of increase in profits over those same 10 years, and I assume that they're directly related. I know that they're not, but I assume that they are for the purposes of this analysis. So effectively, for every dollar the company saves in retained earnings over a 10-year period, I want to know what the return is on that dollar. And you can see this company, it's kind of had its ups and downs. In 2016, it kind of hit the bottom. But for the last 3 years, they've returned over a 75% return on the money that they've saved over the last 10 years. So that tells me this company is doing a good job with the money that they're keeping. So they're keeping all this cash and they're generating a bunch of additional profits for me, the shareholder. And I really like that. And so I am willing to give the company a pass in the short run for not returning money to the shareholders. And I'm willing to do that because it seems like they're generating a lot of profit. Now, if I see this line, this blue line start to drop below the red line, I will start to get very, very nervous that this company isn't doing a good job of returning money. And then I'll really want my money back. And if I don't feel like I'm going to start getting that money from the management, then I'd be looking to sell the company. But for right now, they can keep all the money they want if they can keep doing this year in and year out. One of the things that a company can do with their profits is just hoard it in cash. It's the least efficient thing a company can do. And at some point, I get very frustrated that they're doing that, and I want my money back. And I'm getting to the point that this company might be in that range. And so I would like to see, you can see the line has flattened out in 2018. I'd like to see it continue to flatten out. I don't want to see it continue to go up. Having said that, having cash is a good thing. When things get ugly in the market, you've got the ability to maneuver, you've got the ability to move, you got the ability to pick up other assets at a real discount, and hopefully this company's doing some of that. Or you can wait till the market plummets and buy back shares at what is a discount then. So the company has a lot of cash, perhaps too much cash. Let's see what the company does with this cash over the next 12 months. I'd like to see the cash plateauing, and I don't want to see this company saving any more money because I think they don't need it. If they wanted to pay off their debt, that would be fine, but that doesn't show up in cash. If they wanted to invest in other companies, that's fine, but that doesn't show up in cash. So this cash number is something I will be watching, and I would encourage you to watch as well. So this chart is one of those examples where you can't tell everything from a chart. I would almost not show this chart, except that it's something that I always do. And I think it's important that you see this data and have the ability to decide for yourself whether you still think the company's investment worthy. So all I'm doing with this chart is I'm looking at the myriad of ways that a company can return to stock, can return wealth to the shareholders, and what kind of job this company's doing each year, and what kind of job this company's doing cumulatively over the last 5 years. So what can a company do to create wealth for the shareholders? Well, they can pay off debt. So if the company is paying off debt, then that line would be above the zero line. Is the company paying dividends? If the company's paying dividends, then again, it would be above the zero line. Is the company buying back stock? And finally, is the company keeping cash? And oftentimes these things will move counter to each other. So for example, the company might have a reduction in debt. Simultaneously, they might have a reduction in cash in the same amount because the cash is always used to pay down the debt. So sometimes this gets a little hard to follow. But long story short, when you add it all up, what I also do then is look at what's happened cumulatively over the last 5 years. And when I add it all up, in this case, for some reason, this company actually shows that it has a negative value created over the last couple of years. And while I understand that that appears to be what's happening, and in fact, I think that partially, in fact, because the earnings have been relatively flat the last 2 or 3 years, the fact is I think this company is better situated than it's ever been for an increase in wealth. And I would be very comfortable predicting that this is going to turn itself around pretty dramatically over the next 2 or 3 years. Remember, these numbers are trailing, and so what happened 3 years ago might still be impacting this year. But my prediction is, and my belief is, and one of the reasons I bought the stock, is that over the next 2 or 3 years, this total wealth created will spike significantly up as we burn off some of the things that happened in 15 and 16, which aren't really that important to get into right now. So having said that, I wanted you to see the chart. I wanted you to understand that I'd looked at it and that I had considered it. And in fact, this is one of the reasons why I think the stock is a little bit undervalued. So the last thing I do in the wealth creation slide is I use that as a time to summarize what's been happening in my own portfolio. And this year had been very, very rough. As a result of the coronavirus, we were down 30% at one point, and it was really ugly. Almost every stock that I owned was down, and down very, very significantly. I wasn't unique in that situation, but one of the things that had really bothered me is that my goal is to outproduce the S&P 500, to create more value than the S&P 500. And the logic behind that is twofold. First, that's what Warren Buffett's goal was, and so if it's good enough for him, it's good enough for me. It's a good enough litmus test for me. But more importantly, if I can't beat the S&P 500, then why am I doing all this work? Why am I investing all this time and energy to this research if I could just buy the S&P 500 and go play golf every day? So so that's the goal, is to beat the S&P 500. And I beat the S&P 500 in 2018, and I beat it in 2019, both years pretty handily. This year, at one point, I was down about 12% relative to the S&P 500 and was really, really frustrated. Here I was thinking that I'm buying all of these very, very conservative companies with very strong balance sheets, with very good ownerships, with competitive advantages, and I'm just getting slaughtered. And I was really, really frustrated by it. But the good news is over the last 6 weeks, that has turned around. Yesterday was the first day all year in all of 2020 that I had actually been ahead of the S&P 500 for the year. The last couple of days I dropped down a little bit, but very, very fractionally, and I think we'll manage to make a pretty nice return relative to the S&P 500 this year. So I just wanted to talk about some of the things that have happened since the last post. First of all, I sold the Walt Disney Company. I talked about that and the reasons for that in the first video that I did on the overview of Electronic Arts. So if you watch that video, you'll understand that even though Disney has done well since I sold it, I think it's a company that's very poorly situated for a pandemic. I think that the amusement parks are going to struggle. Movie theaters are going to struggle. ESPN, which is one of their businesses, doesn't even have sports to broadcast, so clearly they're going to struggle. I don't see people getting on the cruise ships for a long time. Disney has 36,000 hotel rooms just at Disney World alone. I think those assets are going to struggle. So I just got out of it, and I used that money to buy EA Sports and Cisco. And since I bought those two stocks, they are up, it looks like 9% for Cisco and 4.1% for EA Sports. So done okay with those assets. Prior to that, I had sold two more companies. I had sold I sold one company, Warner Enterprises, just because I thought it had a really good run up. Their stock had gone up about 16% since I bought it. That was my goal, so I sold it. And I used that money and some money that I had left to buy a series of small positions in H&R Block, LyondellBasell, Medifast, T. Rowe Price, Waddell & Reed, and Waco. Those were all companies that I had done previous videos on. And oh, by the way, all of these trades were posted on Twitter the day that I made them at the price that I made them. So you can go back and check that if you want. But I've done very, very well on most of those positions. For example, T. Rowe Price is up 30% since I bought it. Medfast is up 18% since I bought it. I'm not necessarily going to sell any of those stocks right away, but I've done okay on those. And then before that, a few weeks before that, I bought more of a series of other stocks. I bought more Ventas, Paychex, MSC Direct, and Children's Place. And by the way, the Children's Place asset's done fantastic. It's up 130% since I bought it. So long story short, for the year, I'm down about 7%. The S&P 500 is down about 6.5%. So I'm about 1% behind the S&P 500. I feel like I'm going to catch them. And I'll give you, if you guys want, you can just freeze this and study the slide on your own just to see what we own and how much of it we own. I feel like I own too many stocks right now. And I feel like I have no reserves. So don't be surprised if over the next 60 or 90 days I start selling some of these stocks that I've done well on and build up some reserves. I'd like to have, 15% maybe of my investable money in reserves so that when I see a good stock I can buy it. And right now I have, less than 1%. So anyways, that's all I've got today on Electronic Arts. Thank you very much for your time, and please subscribe and like.